Hello everybody and welcome back. This is the lesson 5 of the tutorials, and this lesson is going to be a little bit easier. We are going to be talking a little bit about the sister to our last lesson, which was the cumulative distribution density function. We are going to be talking about the frequency distribution density function. So kind of a similar concept to the bell curve and the cumulative distribution, but with the frequency distribution function, our x-axis is actually going to be the raw value. So when we have a data set, in this example, we're going to be using Microsoft. When we have a data set, we can break down our values into standard deviations or into probability that it goes higher, lower, using the cumulative distribution, or we could just break it down simply by the actual raw value that rests within this distribution, which is the frequency distribution. So if this were to be Microsoft, we would have our values down here, probably 220, 240, 260, 280, 300, 320, etc., etc. On our y-axis, we would have how many instances of that price range did we experience. And from this, we can see where the accumulation arises. So it looks very much like a bell curve, right? It's a histogram. It will look very similar to a bell curve because usually the accumulation of price rests in a mean. There's along a mean of trading values. So we'll see an accumulation and it'll taper off on the right and left tail. So we can sort of visually see what a cumulative distribution looks like, or a frequency distribution looks like, if we launch an indicator that I released a little while ago. It's called the frequency distribution overlay. And when we launch this, it's going to default to 500 candles back. So we're going to leave it at that because that's actually exactly where I was interested in looking. So back in November, December of 2021, it extends right down to our October low, and it is incorporating all of this really great data. So when we look at this, we can see a couple of things. We can see that the majority of the accumulation, or the majority of the price, has accumulated in a range of 286 to 250. And that has been 30%. That has consisted of 30% of Microsoft's trading history within the last 500 days. The next highest area of accumulation is 355 to 322. And 26% of Microsoft's values have fallen within this range over the last 500 days. So these are very important information because we know where the higher density of price accumulation is within Microsoft. And so this is kind of similar to using Fibonacci, which I don't truthfully have any knowledge of. Just from what I've passively absorbed from watching technical analysts. If we were to draw a Fibonacci, like the Fibonacci retracement levels here, I think you go from your swing high, which would be just like a high value, to your low value. You would see a bunch of Fibonacci retracement levels, right? So these here are all, I presume, to be Fibonacci retracements. Now, if we overlay our cumulative distribution, they don't really line up that well. Yeah, they don't really line up that well. So I'm not really sure how Fibonacci works with trading. I understand the theory of Fibonacci values, but not as applied to trading. But I think the underlying conception is that the Fibonacci sequence repeats in general natural phenomenon. So you'll see repeat values, and this is trying to quantify where those repeat values should happen. So the theory underlying Fibonacci retracements is kind of the same theory underlying using the frequency distribution. However, the frequency distribution is actually using the data set itself to plot those areas of potential retracement and actually giving you the density reading for those specific areas, right? So what we're going to do is we're going to go ahead and we're going to export this data so that we can make a chart just like this. So to export this data, you should probably already know by now. I think we've done it quite a lot, but we go up here, we export our chart data, we go to our ISO time, and we're going to export it. So the first thing we want to do is we want to see the date that we want to control for. So we want to control for this day, right? We want all of this good data from our high over here, all down here to current day. But before we accept this data set, we really should be checking if it is normally distributed. So we're going to go ahead and launch SPTS, and we are going to run the test of normality for this data set. So once we select our data set to analyze, we're going to go up and we're going to select test of normality. Okay. So we have our results here. We see there's a little bit of skewness by the kurtosis, but overall the assessment is normally distributed. So this is great. We can go ahead and accept this data set as the data set that we are going to use. So next we're going to actually perform the frequency distribution in Excel. So we have our start date of November 2021. So we're going to open up our data set and we're going to remove all of the data that is not November 2021. So we're going to go down to 2021, November. So now that we have this, what we're going to do, because we want to plot a frequency distribution, we need to have the ranges we want to plot. And the ranges need to be based on something that is mathematically sound. So the first thing we need to do is we need to determine our max and min. So to do that, we're going to go equals max, and we're going to highlight this, and there's our max, then equals min, and there's our min. Okay. Now to develop the ranges, what we should be doing is we should be dividing this range by the standard deviation. So we're going to create another variable called standard deviation. And if you remember from previous lessons how to calculate this in Excel, it's just equals standard dev dot p. We're going to do right here, enter. Okay. So there we go. So our max value is 359 and our min value is 214.25. Okay, so now that we have these variables inputted, we're going to create three new variables really. So we're going to say frequency from frequency to, and then bin. Now our frequencies from is going to start at our lowest value, so our min value, and that is going to go to this plus standard deviation, and we're going to put a little $sign, then enter. And then the next one is going to be this plus 0.01. We just want to change the percent. And we can carry this down. And then we can carry this all down until we have our max value in the series. It's not there yet. We have to do one more. 393. Okay. Now for our bins, we're just going to take the values from this and put over here. Okay, so 214.25, 250.15, 286.05, 321.95, and 357.85. Why we only have to put the 1 is because Excel understands, oh, you're going from 214.25 to 250.15. I understand that you're looking between 214 and 250, right? So Excel's gonna make the logical conclusion that this is the standard deviation is going to be our search range, okay? So now once we have that inputted, we're going to go to data and data analysis. Now, if you've never used Excel, chances are you haven't used Excel for like a little bit more advanced statistical processes. So if you haven't, you might not have the data analysis tab enabled. That is fine. All you do is go to File, you go to Options, we go down to Add-ins, Manage Excel Add-ins, and we're going to make sure we have Analysis Toolpack and Analysis Toolpack VBA enabled. We collect those and then OK. So once you've done that, we're going to do a histogram. Our input range is going to be here. We're going to make sure that we toggle on the labels because we are including the labels here. Our bin range is going to be L. We're going to chart the output, and our output range can just be right over here. And then we can click OK. And here we go. So here is our frequency table. And here is our histogram. So if we want to open up this histogram, we can go into chart design. We can just make it look more like a standard histogram, which is no spaces like this by using the chart design function, the quick layouts, and you just choose this one, layout 8. And so this is our histogram. So we can see visually where the price is accumulating, and it is accumulating in this range here, 286.05. Okay, very few here, very few here. So we can expect this 286.05 range to be very important. Okay. Now if we flip back to our Microsoft chart, we can then plot out those frequency levels, right, from here. So our pivotal level seems to be this range here, 286 to 321. So we could even draw a box if you wanted to do that from 286 to 321. And you can see when we do that, look where Microsoft found support here. When we came back down, we fell into this, we retraced into this high frequency zone, and this is where we found support. Okay. So it works very similar to the cumulative distribution density, but it just helps you see visually where a lot of stuff lies. Okay. Now you can do this on any time frame. The easiest way to honestly do this is just by using the indicator that I created to do this for you. So frequency distribution overlay. And this is going to be the easiest way to do it on all time frames. You can use, for here we would probably want the frequency for this whole area. So again, we can use the period candle counter to collect all of the data in this range. So 775, we can extend this to 775. And there we go. So based on the 1 hour time frame over this period, you're going to want to check, of course, to make sure this is normally distributed. I know it is, so we'll just skip that step. But over this period, we can see that our accumulation rests within the 338 to 329.1 range. And so we can expect this to retrace back into this range at some point, right? So back up to the upper level at 338 and as low as the 329. Now, you'll see that these ranges act as quite substantial support and resistance. That is because we are breaking it down by standard deviation. And what standard deviation is a measure of is the variance within the stock. And when you are plotting the ranges by the standard deviation, you're plotting the ranges essentially by the variance that is permissible with each stock movement. It's the same principle as Bollinger Bands, which I find to be a better strategy than most if you are a technical analyst. And the concept of Bollinger Bands I use in quantitative analysis and technical analysis. So it's the same principle as that. By looking at the variance based on the standard deviation, it gives us really key levels to look for as support and resistances. You do have those like fake out moves like here, but when you have the context of, how likely is it to stay in this range? Well, it's 14%, right? The accumulation in this particular range is 14% versus falling back in, it's 42%. If we were to view that we can view that as a probability, right? The probability we stay in this range is 14% because based on the historical value of Microsoft over these past 775 hours, it's only stayed in this range 14% of the time. The probability rests with it being between 338 and 319. These are our high frequency ranges, right? Now, of course, it's not going to work when we are in a bull market and we're just going up, up, up. The frequency and cumulative distribution density function, these two things are not going to work when there is just an unfettered bull market like we saw in 2021. I had a really hard year in 2021 because it was just unfettered bullishness. The cumulative distribution, the frequency distribution, the quantitative things that I used to look at to determine reversals, they weren't really working because we had so many fundamental things like there was quantitative easing, there was a lot of other stuff. And it really threw me off in 2021. I had a really difficult year at the start. And then I realized this must be a fundamental move. It must be from the economics. So I'm just going to long everything. And that's okay too, right? You have to, quantitative technical analysis, it's not enough. It's not enough on its own. You really do need to understand what is driving the market from a fundamental perspective, right? You need to make sure that the economics are supporting your quantitative analysis or your technical analysis. Right now, the current economic situation is the perfect situation to use these kind of strategies and tools because we are in a ranging market. We are ranging. This is like the best market you can have for both technical analysts and quantitative analysts because the stocks are retracing to their high frequency zones. They're respecting their cumulative distribution densities. Pretty much everything at this point is normally distributed from 2022 to now because we've just been ranging. And these are the ideal situations for both technical analysts and for quantitative analysts. So great, but don't ever forget the fundamentals are important. And we'll talk more about that in later lessons. But as of now, I'm going to call this lesson finished. Thank you for watching. Safe trades, everybody, and take care.